we go.
Welcome to Do Different Better Show, where we talk about wealth, wisdom, and money moves, making finance simple for everyday people. I'm your host, Elaine Rasmussen, founder and CEO of Social Impact Now, Connect Up Institute, and general partner of the Integrated Capital Fund. Thank you for joining me today. Today, we're exploring a critical and timely topic. We're going to explore why it's important more than ever for women to take charge of their financial future. We're going to talk about how to get started, the opportunities available, and what you need to know before diving in. We'll discuss the upcoming multi-trillion-dollar transfer of wealth to women, the barriers that women are facing in investing, and how to overcome them. Let's get started. So, first off, why is women investing important now more than ever? Today, we're focusing on women in investing, a topic that's so relevant right now. There's going to be a significant wealth transfer on the horizon and an increasing earning power for women. Women are poised to be major financial influencers. However, there are some barriers that often prevent women from taking the plunge, not only into investing, but taking control of their own financial future. And addressing these barriers is crucial and for your own financial empowerment. This is for your daughters, your sisters, your aunts, your moms, really to let all of their fears and anxieties go and really move into managing their own financial well-being. So first, let's talk about this multi-trillion-dollar transfer of wealth. Over the next decade, we're expecting a massive shift in financial power. Women are projected to inherit a substantial portion of the estimated 30 trillion, that's T, trillion with a T, in wealth. And that is set to be transferred by baby boomers to their heirs, not only their wives, but their children. This shift is due to the generational wealth transfer, longer life expectancies, and increasing participation of women in the workforce. Currently, women control over 10 trillion US household financial assets, and this figure is expected to grow significantly. This means more women will have financial means and influence to make influential investment decisions. But why is this important? When women invest, they not only secure their own financial futures, but also they have the potential to drive social positive change. Women tend to invest in ways that align with their values naturally, such as supporting sustainable businesses and fostering community development. Now, here's a fun fact. Women are likely to invest in companies that have strong environmental, social, and governance practices. This is sometimes called ESG. We've talked about this in another show. These types of investments can lead to better longer-term outcomes for society and the planet. And females and people of color investment managers typically outperform their peers by 12%. May have noticed I have a special guest joining me today. This is Mr. Skittles. He loves to join me on my calls. So we'll see if we can get him to say anything later in the show. But despite these opportunities, many women face barriers when it comes to investing. Some of these common barriers include a lack of confidence, maybe they're risk averse, or maybe they have some knowledge gaps. We talked a little bit about some of this in the previous episode when we talked about money mindset. So I'll share a little bit of my own personal story. When I first got started thinking about investing, I was so overwhelmed. I didn't feel confident in my abilities to make the right decisions. There was so much financial jargon. The risks seemed overwhelming, and the fear of losing money, all of these things held me back. It wasn't until I sought out information and support that I began to feel empowered. Many of the male advisors that I did talk to, the investment advisors, were at best patronizing and condescending, and at worst were chauvinistic and outright sexist. That also didn't play well to my experience and the fears and anxiety I already had. Many women experience these similar challenges. Studies have shown that women are more often risk averse than men, which can prevent them from even learning about their own financial destiny, but also prevents them from actually acting and activating and becoming investors. Additionally, the financial industry has been historically male dominated, which can make it very intimidating for women to enter the space. hence my previous experience. Another gap and barrier is the knowledge gap. Many women feel that they lack the financial literacy needed to make informed investment decisions. But here's a little secret, that's what professionals are for. But this is often compounded by societal expectations and traditional gender roles that have positioned women, or actually positioned men, as the final financial decision makers. But there's good news. These barriers are easy to overcome by seeking information, getting education, getting support either as part of a community, seeking the advice of an expert or professional. Women can build the confidence and knowledge needed to start investing. And so here is my call to action to you. I want to encourage you to identify your own barriers to investing. Is it a lack of confidence? Are you feeling overwhelmed? What I want you to do is take some time, maybe over the next 7 days, and just really sit down. In our previous episode, we talked about money mindset and really understanding what are the tapes that you have about money, the tapes that are playing in your head about your finances, the tapes and signals that you may have received growing up, and how are those influencing how you show up today and thinking about money or thinking about investing, or even what is your place? Do you even have a place in talking about finances, or has that always been left to the traditional gender male in your family? But once you've identified any of these barriers, whether it is you would like more information, whether it's that you would like to be in a community, maybe you want to join a Facebook group, maybe you actually want to start talking to a certified financial planner, maybe we received an inheritance and you really need to talk to a wealth advisor on what you should do, what are the options. That these are all things that you can do, but figure out what is it that you need to begin the journey and to start to feel more comfortable. What are the barriers? Or do you find that you don't know anybody in your circle who can direct you to some of these resources? I bet if you did a search, you'd probably be able to find some, or just started asking your friends or colleagues at work. If you're in a 401k, call up your 401k and ask them if they have somebody you can talk to. Many 401k plans actually have somebody, while they won't tell you where to invest, that is not their job or their role. They can take you and provide you with a set of resources, either within their organization or outside their organization. And some of these resources are actually 100% free. And at least it'll start to get you to get the information you need to start your journey on figuring out what do you know, what do you not know, so you can start to create a plan to figure out what more things do you know that you need to know. But once you've identified these barriers, you can then start to take steps to address them. You can start to seek out the resources, join financial education workshops. There are many libraries and community programs in your community, in your city, that are available to you. And actually, sometimes some of the large companies like the Schwab or the JP Morgans, or some of these larger companies, TD Waterhouse, sometimes they have workshops online that you can join for free. They might even have some sessions that you can do in person locally in your community. And that's how you can start to build a community around your wealth education. But there's so many things that you can do, but the first step is to do something. So what you want to do is start this journey, start writing it down and tracking how you're doing, where you're going, what's coming up for you. Are you feeling anxious? What about it is making you anxious? Is it because you don't have information? Is it because you don't have resources? Is it because you're afraid of being judged? What are all the reasons? Start journaling this journey. I think you're going to find, excuse me, I think you're going to find that, first of all, where you start and where you are maybe a year from now, it'll be interesting to look back at this time and say, wow, look at where I started. I knew nothing. And now look where I am. I've made my first investment, or I have found out what I'm invested in. Another powerful thing that I ask people to do is go find out what's in your 401k. Most people never know what's in their 401k. And it's actually someone's job to tell you what's in your 401k. They get a percentage of your 401k for managing that money. And they are supposed to take those phone calls of people who are interested in knowing what's in their 401k. And guess what? They never get that phone call, right? That's not to say that they get paid for doing nothing. They're managing your money and making sure that it continues to grow. But part of their job is also to answer your questions. So leverage them. Go find out who they are. If you're not sure on your statement, your 401k statement, that should be coming into your inbox or it may come into your mailbox. There should be a contact phone number on there or a website on there of people you can contact, of the folks who are managing your 401k, and just say, hey, I'd like to know the companies that are in my 401k. And they should be able to tell you what's in your 401k. And they should also be able to tell you, like, answer questions you have about why are they investing, what they're investing in, what are the things that they take into consideration. And this is once again another free resource that you have for you to be able to start to learn about how you can take control of your financial well-being. So remember, you have the power to take control of your financial future. So that's it for this segment on why women investing is more important than ever. Stay with us. Next, we'll explore the various opportunities available for not just women, but anybody to invest in. Remember, understanding and addressing the barriers is the first step towards your financial empowerment. You're listening to Do Different Better. I'm your host, Elaine Rasmussen. See you in the next segment. Welcome back to Do Different Better. I'm your host, Elaine Rasmussen. And in this segment, we are going to explore the diverse world of investment opportunities that are available, from traditional investments to alternative investments, and what are some of the emerging options that are available. And there's really something for everyone. So let's dive in and see how you can make your money work for you. Now, first, I want to give a disclaimer. I am not a wealth advisor. I am not an investment advisor. I am not a certified financial planner. So I definitely encourage you to take the information from this show and talk to a professional about how this relates to your personal financial story. Everybody's financial story is going to be a little bit different. And that's due to everybody has different jobs. Everyone has different familial responsibilities. Everyone has different life goals. And based on all of those things, your income trajectory, a professional can help you think about what might be the best strategies, considering not only your current situation, but what might be your goals. So here's a little introduction and overview of investment opportunities. And we're not going to talk about the full gamut, the full wide world of investing. That could probably take up 5 shows. But I'm going to give you a high level overview of some things for you to just get the ball rolling, dip your toe in the water, make it nice and easy, and hopefully tickle your brain to be able to think about, I want to learn a little bit more. So investing is a very powerful way to grow your wealth and achieve financial independence. Today, there are more opportunities than before to cater to a wide range of interests and values. Whether you're looking for traditional investment, you're interested in impact investing, and we've talked about that on previous shows, or exploring cutting edge innovations like cryptocurrencies or blockchain, there's an option that can align with your financial goals and your personal values. It's very important to remember that investing isn't just about money. Obviously, that's could be part of your financial goals, but it's also about creating the future you want to see. Maybe you're looking to eventually move off the grid in the middle of Montana. Okay, what is going to be the life? How much is that going to cost? And what is the life that you need? How much money do you need to sustain that lifestyle? Right? So no matter whether it's your plan is to retire in Fiji or you want to move to a commune, doesn't matter. You can start to think about, how does your money play a role in that, and how can you activate your money to ensure that that dream happens? So by choosing where to put your money, you have the power to support communities, initiatives that align with your values and the vision, your vision for the world, as well as your own personal life goals. So first, let's talk about traditional investments. Traditional investments are the cornerstone of many investment portfolios for decades. The traditional investment options are typically what you're going to see, like in your 401k plan. These are also probably the things that your parents invested in and your grandparents invested in, the stock market, some other types of things, and we'll talk about those in more detail. But all of these categories or types of investments, they are called asset classes. You may have heard this word if you've ever caught 5 minutes of Bloomberg or any financial channel. You might say in this asset class or that asset class. These are the categories that I'm going to be talking about. Usually there's about 5 or 6 and there's some percolating asset classes, and they all have different limitations, characteristics, but also opportunities. But we will get into a fuller conversation about asset classes in a future episode. Once again, disclaimer, I am not a registered investment advisor. Please seek out investment advisor support or do your own due diligence on any investment opportunities. And we talked about what the due diligence process, and I believe it was episode 6. So go catch that episode. So let's talk about some of the major common asset classes that you may have heard of. First is stocks. When you buy stocks, you are purchasing a small piece of ownership in a company. Typically, these stocks have the potential for really high return on their investment, but they also come with higher risk. The key to investing in these kinds of companies is that you believe and hold on to your investment for a long period of time. And when we say long period of time, we're talking about at least 2 to 3 years and anywhere up to 10 or 15 or 20 years. In the old days, there was AT&T. Actually, there was the Bell companies, and that was the company that had all the telephone lines from New York to California. Well, I believe it was in the 80s. I was old enough to remember when this happened. Maybe it was the late 70s. But the government came in and said, you have a monopoly on the phone lines. We need to break up all of these entities into smaller organizations. And that's when we came up like with Pacific Bell or Eastern Bell, or there were all these other phone companies which have now been merged into other companies such as AT&T, Verizon, and other types of companies. Well, Verizon probably wasn't a company, but AT&T was a landline company before becoming a mobile company. So these companies, if you were to have bought stock back in 1977 or whenever the companies were broken up, and let's say you bought $100, right? If you held on to that stock, let's say you held on to that stock for 50 years and you passed that stock down to your children as an inheritance, the value of that stock has only gone up. And the person who inherits that, or if you decide to cash out your particular stocks, however many you have, and many times there's some stocks that have limits on how many you can buy. There are some stocks there are no limits on what you can buy, but some stocks also have minimums. You have to have a minimum purchase amount to vote, or there's a minimum amount to participate in the shareholder meeting. But once again, those are all details we'll get into another show. But the big thing that I want you to know is stocks are what's called publicly traded. That means that they are out in the marketplace. You can think of it as being able to go to a grocery store versus being able to go to Costco. Costco is a membership-based store. You have to be a member to go in there, right? So it's not open to the public, right? That would be what's called private market. And we probably won't get into that today. But the public market is where stocks are traded. So the New York Stock Exchange, that's when you hear that word, the New York Stock Exchange, that is one of the big stock exchanges where stocks are bought and sold. And there are platforms, I believe Charles Schwab, there's TD Waterhouse, there are platforms where you can personally, individually trade. You don't have to be a licensed stock trader to be able to buy and sell stocks. But the whole idea that I want you to wrap your head around is stocks is an asset class, and what they represent is you own a small piece of the company along with all the other people who have bought stocks in the company. And that the whole idea of stocks is that you're putting in some money for a large return. Sometimes you'll hear people say, I'm looking for a 10x return. That means they want 10 times the money that they put in. So if they say, I want a 10x return, I put in $100, I want $1,000 return on my investment, right? So that's the general sort of highlight of stocks. Next, there are bonds. Bonds are essentially loans you give to a company or government. In return, you receive interest payments and the return of your principal at maturity. So what does that mean? You may have heard things like treasury bonds. That's one, particularly people in my generation have heard their grandparents, they may have inherited a treasury bond that their grandparents bought or something like that. Basically, that is you are loaning money to the government in that particular instance for them to go build a project, to do other government work. And then they're going to pay you like you receive interest from a bank or you pay interest on your mortgage. They're going to pay you interest on that money. So let's say you bought a bond at $100. Let's say the interest is going to be 10%. They're paying you an annual percentage of 10% of that $100, which is $10, right? They will pay that to you every year until the maturity of that bond. The bond might be a 10-year, a 20-year, or 30-year bond. In that 30 years, not only are you going to get the annual interest of $10 every single year, you're also going to get your $100 back at the end of that 10 years. Right? So that's how bonds work. Bonds are generally considered much more safer than stocks. They don't have the rise and fall that you see with stocks. So sometimes you might say, oh, Apple stock is doing great. Apple stock went in the toilet, right? Stocks have this volatility. They go up and down. But over time, generally, the trend goes up. But bonds are pretty much a flat line. They're considered super, super safe and very less likely to lose money. And then we're going to get into mutual funds. Mutual funds are a pool of money from many investors and to buy a diversified portfolio of stocks. Your 401k may buy into mutual funds. So they're taking all the employees' money and they're putting it into a pool of other people's money to buy portfolios of stocks. So that was our first one, right? Stocks. But they might also use this money to buy bonds or other types of securities. And this diversification, it's called diversification by having your money spread out in different types of ways, different asset classes to reduce the risk of losing your money. And it also simplifies the investment process, right? Especially it's one of those kind of set it and forget it. If you're really looking to like not be so actively engaged, doing something like that of where you're putting your money into a pool of funds might be the thing for you. However, the thing to note is as you start to pool your money with other people's money, whether it's a mutual fund or some other vehicle, you start to lose sight of what's actually in the fund, right? So if you were trying to say, hey, I don't want to be invested in prisons, it might be difficult to do that because you're pooling your money and you don't get to dictate where your money goes as opposed to all the other money in the pool. So another popular traditional investment is real estate. Real estate involves purchasing property to generate rental income or to hold and sell at a profit, or both. This can be a lucrative way to diversify your portfolio and build long-term wealth. Here's a fun fact. Historically, women tend to perform better in the stock market than men. Studies show that women are more patient and consistent in their investment approach, which often leads to higher returns over time. Here's some alternative investments. So we've talked about impact investing on previous shows. Impact investing allows you to invest in companies and projects that align your personal values and contribute to positive social and environmental change. This could include renewable energy projects, affordable housing, or companies that have very strong ethical practices, whether it's sourcing practices, hiring practices. You may have heard there are things about, issues around Uber and Lyft and things like that. So people might choose not to invest in those companies because there's questions about their ethical hiring practices. Another opportunity is peer-to-peer lending or crowdfunding. These are where you see Kiva, you might see iFund Women. These platforms allow you to lend money to directly to individuals or small businesses, often with the potential of high return. But crowdfunding also allows you to invest in startups and innovative projects that may not be that may not be accessible through traditional investment channels. And we'll talk about it on why that might be the case. It's not because they're bad investments, but it really has to do with more rules and regulations that govern investment advisors. Then finally, there's cryptocurrency and fintech innovations. So cryptocurrencies like Bitcoin, Ethereum, Cardano offer a new frontier in digital finance. These decentralized currencies can be also volatile, but they also present opportunities for some significant gains. Additionally, fintech innovations are creating new ways to invest and manage money, such as robo-advisors and blockchain technology. Finally, let's look at some emerging investment opportunities that are particularly exciting. Sustainable and green investments. As the world shifts towards sustainability, investing in green technologies and companies focused on environmental responsibility, such as supply chain social responsibility or environmental responsibility, these kinds of investments are becoming increasingly attractive. These investments not only offer potential financial returns, but also contribute to a healthier planet. And then finally, women-led business or female-focused venture capital funds. Supporting women-led businesses can be a powerful way to promote gender equity and innovation, particularly women of color running a venture capital firms. Investing in female entrepreneurs or venture capital funds that focus on women-led startups helps us bridge the funding and all the other gender equity gaps but can also lead to impressive returns. There is data that says that it demonstrates you give money to a woman that they are going to be amazing stewards. They are the best stewards of that money. So here's my call to action to you. I encourage you to explore these diverse investment options and consider how they fit into your investment portfolio. Remember, diversification is free, meaning spreading your money out in different opportunities that have different returns so you can have a balanced portfolio is the key to managing your risk of losing your money and maximizing your returns on investments. So don't be afraid to mix traditional, alternative, and emerging investments to create a balanced strategy that aligns your financial goals with your personal values. So that's it for this segment on investment opportunities. Whether you're just starting out and looking to expand your portfolio, there are countless ways to make your money work for you while supporting causes you care about. Stay with us as we continue to explore how to build a healthy and empowered financial future. You're listening to Do Different Better. I'm your host, Elaine Rasmussen. See what's coming up next. Welcome back to Do Different Better. I'm your host, Elaine Rasmussen. And in our final segment in this episode, we're going to discuss what you need to know before you invest. It is crucial to be well prepared and informed before making any investment decision. We'll cover how to assess your financial situation, set some realistic goals, and align your investments with your values. So let's dive in. Investing can be an excellent way to grow your wealth and secure your financial future, but it is important to be prepared before you jump in. Making uninformed decisions can lead to unnecessary risks and potential losses, and that's not what we're trying to do. That's why understanding your financial position today and having a clear roadmap is essential for successful investing. And this is where a certified financial planner can come into play. You sometimes will see the letters CFP after someone's name, and that means that they are a professional, kind of like a licensed broker or a licensed doctor. They are certified financial planners. This is somebody who's going to sit down with you. They're going to talk with you. They're going to hear your story. They're going to talk to you about what are your goals for yourself, for your children, how long, what is the typical life expectancy, and how much money will you need as you move towards the third chapter of your life. What is that going to look like, and how much money are you going to need to live the life that you're designing for yourself? So think of investment as preparing you for a road trip. Any kind of, like any other journey, you wouldn't want to start on a road trip without checking the car, making sure like the air is in the tires, that you've got windshield wiper juice, that make sure that there's gas in the car. You might even plan your route for some of us, or some of us may be passenger princesses and we let somebody else do that. But somebody is doing it and making sure that you pack for your essentials. I know when we go up to the cabin, before the town where our cabin is was built up, I had a whole packing list. We would go to Sam's Club, or we would go to Costco, we would go to the grocery store, pack up the coolers, but I had a whole checklist. I even had a packing list for every time we went to the cabin. I'm like, oh, okay, we're going to need the 2 towels. We're going to need, right? This is kind of very similar. So before you invest, you need to ensure that you have as much of the necessary information and resources that you need as possible. So, how do you assess your financial situation? Let's start by preparing to invest. The first step is preparing to invest, assessing your financial situation. This involves understanding how much money you have available to invest without compromising your daily expenses or emergency savings. One of the things that I was told when I was younger is think about what is the amount that you can lose, right? Especially if you're doing an investment that may be not part of the traditional investments that we talked about earlier. If you're doing something that's alternative, or maybe that's a little bit more experimental or new to the market, I've made some investments in companies, but I really came with the perspective of, if I never see this money, I'm going to be okay. Right now, that's not the plan. The plan is that I have some kind of return on investment, but I've made some investments. I thought they were great companies. I'm still am friends with the founders. They just didn't make it for a lot of different reasons, right? It may have been external factors. COVID was an external factor for a lot of upstart businesses. And while they may have had a great idea, it was bad timing, right? They may have had a great team, but it was bad timing due to external resources. Opening a massage parlor or a massage franchise in the middle of COVID was not the best idea. And there's nothing you can do about that, right? So one of the things that you can do is start by creating a budget that outlines your income, your expenses, and any other existing savings, or other ways that maybe you might be expecting an inheritance at some point in time. Maybe you are expecting bonuses at certain points of your annual year because you're on commission, or you get merit bonuses where you work. Think about all of those things. This will start to give you a very clear picture of your financial health and help you determine how much money you can comfortably allocate to assets. And with your wealth advisor, your investment advisor, or your financial planner, you can start to think about, how do you want to carve up that set of money? So once again, let's think about $10,000. You have $10,000 to invest. Your financial planner may sit down with you and say, okay, what's the return you're looking to have on this money? How long do you want this? How long are you willing to let this money sit? Are you going to need this money in a year from now because you're doing renovations on your house? Are you going to need this money 4 years from now because you've got a kid going to college? How does this money need to work for you, right? The next thing to do is to really set some realistic financial goals. What do you want to achieve with your investment? Like I was just saying, are you saving for retirement? Are you saving for a down payment on a house or your grandchild's education? When you have some specific goals, this will help guide your investment strategy and help you stay focused, right? But it's also just as important to understand the potential risk and losses associated with investing. No investment is completely risk-free. If anyone tells you they've got a sure thing, they're lying. It's crucial to be prepared for the possibility of losing some or all of your investment. Understanding your risk tolerance, meaning how much risk you're willing to take or are able to take, will help you make better investment decisions. So typically when the rule of thumb is when you're younger, you can take more risks because the idea is that you have more time to make up any losses, meaning that over the course, let's say we're looking at somebody who's 25 years old, may have a more higher risk tolerance for losing money because let's say at 30, they lose all their investments. They lose all their money from their investments. Well, they're 30. The idea is, all things being equal, they have all this extra time to go and make up whatever money they lost, plus make some more. Now, somebody who's now moving into their 60s, their 70s, there's not as much window. So at that point, typically the advice that's given is let's be a lot more conservative with your money because now this is the money you have to live on because the presumption is you may either stop working or significantly reduce your working hours or your working income. So your advisor might say to you, hey, since you're older, we don't want to put your money at risk. We're going to put your money into things that have a very slow, steady rate of return, right? Meaning maybe it's got a 5% rate of return as opposed to the stock market may have an 8 to 12% return. Or if you invest in a venture fund, maybe there's a 20 or 30 X rate of return. So these are how the financial planners will start to think about your particular situation, not only where you are in life financially, but where you are in your life chronologically, and help you inform you on what kinds of decisions that you can make. But understanding your risk tolerance and how much you're willing to take will definitely make you make better investment choices. Here's another fun fact. Women are more likely than men to invest in a long-term perspective, which can lead to more stable and consistent returns. This patient approach often helps women weather market fluctuations better and achieve their financial goals over time, right? Maybe this goes to what we talked about earlier of just not feeling confident and being able to make lots of different maneuvers. Maybe it's they're too busy because they're not only working their job and they are raising children, but the fact of the matter is women are much more patient and they leave their money and let it sit and let it grow and let it mature as opposed to constantly making new opportunities or investment choices. Not saying that that's bad, right? I'm just saying that there is study research that says how women invest and how men invest is different. But also I think the other thing that might play into this is women live longer. That's just a statistical fact. And so women have to think more longitudinally about their financial well-being, perhaps than men. I think the average now is women live on average 8 years longer than men. So when you think about that, you're going to be 8 years on your own without spousal income, whether that's pensions, whether that's Social Security. Those are significantly reduced once your partner passes away. So in thinking about that, okay, as a woman, I've got to be thinking about how do I make up that income? So I really need my investments to be safe, secure, and produce the income that I need. So now let's talk about reflecting on your values in your investments. Another important aspect of investment readiness is aligning your investments with your personal values. Not everybody believes this as a tactic. This is something that's really important to me, and I invite you to think about adopting it for you. This is not only having your investments align with your values not only ensures that your money is working towards your financial goals, but also supports the causes and practices that you believe in. It's sometimes called value-based investing, and this can take many forms, such as ethical funds, social impact bonds, companies with strong environmental, social, or governance practices. There's that word again, ESG. For example, if sustainability is really important to you, you might choose to invest in a green energy company or funds that prioritize environmental responsibility. And the trend has been lately, there's lots of funds that specifically are set up for social, environmental, or governance. So locally, we have North Sky Capital. A lot of their investments are in energy related investments. So venture backing companies, startup companies, traditional companies to help them grow their business and they make those investments. There's uh, social justice fund. That is a fund. There's also Just Futures. That's a retirement plan, and it's basically a 401k that you can buy into. That is specifically all the funds in their portfolio are social justice related, or economic justice related, or environmentally sustainable organizations. So here are a few examples of value-based investments. So ethical funds, these are funds that avoid investing in companies that engage in harmful practices such as tobacco production or weapons manufacturing. Social impact bonds, these are investments and projects that deliver positive social outcomes like improving education or healthcare. Sometimes governments will issue social impact bonds, or you might hear pay for success bonds, right? Meaning that the bond only gets there has to be a demonstration that success has been achieved, and then money is doled out accordingly. Then there's ESG funds. So these are funds that invest in companies that meet high standards for environmental protection, social responsibility, and corporate governance. So when we talk about corporate governance, it's like how many women are on the board? How many people of color on the board? Is there gender diversity? Is there ethnic diversity? Is there age diversity on the board? And it is said that the more diverse the board is, actually, the better the company does. There's actually data and research that says that. So aligning your investments with your values can make your financial journey actually more fulfilling and more impactful, not only for yourself, but for the planet and for the companies and the people that work for the companies that you're investing in. It allows you to support these causes or companies that you care about while also working towards your financial goals. But here's something that you definitely need to know. There is a term that's called impact washing, green washing, and these are terms of like companies or investment funds on the surface may seem like they're like great and they're aligned with your values. But if you go like one level deeper and you start to ask, what about, let me see your investment relations paperwork or your investment relations brochure, which outlines how they use their money, information about the company. It gives you another layer, and you're like, well, wait a minute. Maybe it's a portfolio, maybe it's a fund, maybe only 10% of the funds are actually environmentally or social or sustainable companies, and they're marketing it as a portfolio that is a values aligned or impact portfolio. So these are things where you kind of want to just go a little bit deeper and say, okay, what percentage of this portfolio represents ESG? And I'm not saying any of these percentages are wrong or right. This is about you asking the question and what aligns personally for you. If an impact fund only has 5% of their portfolio invested in impact companies, is that okay with you? Maybe it is, maybe it isn't. I am not here to be the impact police, right? I am here for you to be able to ask good questions to make sure that what you're investing in reflects how you want to show up in the world, right? So, and once again, you can ask these questions to your financial planner, your wealth advisor. Sometimes they'll have the answers, but like I mentioned before, when you start to invest your money into funds, you start to lose control as to where and how you can direct the money because your money is being pooled with other people. So just know that there are some trade-offs as you start to invest in larger with pools of money, whether that be a venture capital fund, whether that be a mutual fund or some social impact bond funds. You don't get to direct where and how that money goes because it's just being pooled to be able to acquire a large portion of ownership of the company or a small portion of ownership. But the whole idea is they're leveraging a whole bunch of people's money and not just your money. But definitely when it comes to your money, you have a more active role in engaging and directing where and how that money might move as far as what types of companies that it goes to, right? Okay. So as we're starting to kind of wrap up here, let's summarize some of the key points that we've covered today. So 1, know your financial position. Assess your income, your expenses, your savings to determine how much you can invest. 2, understand your risk tolerance. Be aware of the potential risk and losses associated with investing and know your tolerance. 3, set goals, establish clear, realistic financial goals to guide your investment strategy. And 4, align your values. Choose investments that reflect your personal values for a more fulfilling journey. If you're feeling uncertain about where to start, don't hesitate to seek professional financial advice. An advisor can help you create a personalized investment plan that provides you great insights. So here's my call to action for you today. I challenge you to take the first step. Research one investment opportunity or schedule a meeting with a financial advisor. Take action now, and you can set yourself to be on a path to secure a prosperous and financial future. That's it for this segment of what to know before you invest. By being prepared and aligning your investments with your values, you can make informed decisions that support your financial goals and create a positive impact. Thank you for taking this journey with me today. Well, that wraps up another episode of Do Different Better with Elaine Rasmussen. Join me in our next episode of Do Different Better. I'll be talking about the power of estate planning. I'll have some practical tips for you to get you started on your estate planning journey. I will see you next week, and I'll show you how to do different better. Let me know what you think of the show. We love comments, so tell us how this show helped you. If there's a money or finance question you have, or if there's someone you want me to interview, hit me up on Instagram or LinkedIn. Don't forget to hit the subscribe button and follow us on our socials. Until next time, let's do different better together. Thanks for tuning in.